I'll be going through with you Pinterest stock and just type it in Google, click enter, and you'll see the name here, Pinterest Inc. It's just from Google, it's very easy. Nothing rocket science. That's the full name, and its pins is the Nasdaq symbol. I want to buy right now. I have to pay 33.43 US dollars for one stock, and it's a billion size firm. Billion size firm means that is a big size firm, right? So it doesn't pay any dividend. I just want to point out that companies that are paying dividend, that means they're financially very, very strong, because even if the dividend yield is less than 1%, even if it's 0.5%, but that means they're very financially strong, because after paying their creditors, loans, costs, they still have extra money. That extra money they are paying to shareholders as dividend. So any firm that is paying dividend, that means they have extra money, they are financially strong. So that's a positive sign. And but this firm is not paying any dividend. That could be maybe they are financially weak, or maybe they have extra money but they choose to reinvest in their own firm to further expand. So instead of paying to shareholders, they'll reinvest that money. So there could be many reasons. So, but this is a very important aspect to know if a company is financially strong or not. So you need to search that why, what are the reasons for not paying dividend, what do they do with that money that they have. So that's very important to know. Now let's see, when was this founded? I can see founded 2008. You can also check in Wiki. If it doesn't appear here, you can just check in Wikipedia. It has all the information about when was this founded. So I want to see, I'll just copy this exactly from Google and paste it here, and I want to see Indeed reviews and see what the employees think about this firm. And so I can see 17 reviews, which is not plenty, but still it's 4.4 star. Read through the reviews yourself, check out the salaries, the photos, the jobs listed, the question and answers. And please check out the reviews in Glassdoor as well. That's very important website as well. I can see 272 reviews and 4.2 star. Read through the reviews yourself. Check out the jobs listed, the salaries they're paying, the interview questions, the benefits they're giving, and the photos. And let's go to Yahoo Finance, and I want to see the key executives and what salaries are they getting. So I'll just paste it here, and its pins is the symbol. And just go to profile, and I just want to show you one more thing, that you can see the sector here, industry here, and the number of employees. And I can see 5 key executives, but none of their salaries have been shown. But that's something to search about, because we need all the salaries of the key executives to be shown. We need to know all the salaries for transparency, for us to build trust with this firm. And it hasn't shown us any salaries, and it says not applicable. Now, this is something to research about, because we need to know all the salaries. So you need to search why it's not applicable. What's the reason behind it? That's very important. Let's go to Justia Patents and see the patents it has. So I'll just paste it here exactly from Google, and you can see, please check out the applicant or assignee, because these are people who have full rights of patents. In 2014 they have a patent, 2017 they have a patent, which is a recent patent. 2016, that's a recent patent. That's brilliant. So not only we need to look at the patents, we need to know recent patents as well, because that means they're still innovating, which is important. And the more patents a firm has, the more stronger it is in the market, and it's harder to beat that firm. That's very important. So you can just go to the patent yourself. And I just want to go to macro trend lastly and see the ratios. Click price ratio, price book ratio, and paste in the symbol over the name. And I just want to point out that if the price book ratio is less than 1, that means stock is cheap, it's undervalued, and it's at discount. If it's more than 1, that means stock is expensive. Let's see, right now it's 2.05, which means that in August 2019, recently, if somebody buys it, they'll be paying twice as much money to buy this stock. So it's twice more expensive. But in 2019 June, it was 1.6 times more expensive. People paid $27 to buy something that was $16 worth in 2019 June. And right now it's twice more expensive if somebody buys in August 2019. And let's go to other ratios. I want to have a look at current ratio. If current ratio is less than 1, that means stock is risky, because liabilities are more than assets. If current ratio is 1.5 or more than that, that means stock is safe. It has a good margin of safety. Please look for 1.5 or more than that. Let's have a look. Okay, So I can see that right now we have data up till June 2019. That's the recent one that this website has loaded, I guess. So on basis of that, I'll analyze. So I can see it's more than 1.5. It's not more than 1.5. So that means that the stock is very, very safe. That's brilliant. Um, and I can see the previous trend. So since 2018 December, I have the data. Up to now, consistently, it's more than 1.5. So it's a very safe stock in terms of current ratio. Let's check it out in terms of debt equity ratio. I'm looking for zero point 0.5 or less than that for it to be very safe. This ratio will tell me if the company is mainly operating on debt or equity. So please look for zero point 0.5 or less than that for it to be very safe and have a good margin of safety. So I can see right now that we have data up till June 2019. According to that, it's less than zero point 0.5. So it means that the stock is very safe according to debt equity ratio, and it's risky. It's risky in it was risky in March 2019 because you can see that the equity was minus and the long-term debt is positive. So the company was mainly operating on debt, which is very risky. And also before that as well it was operating. So just recently, I would say, the previous trends are very risky, but just recently the stock has become safe because it's operating mainly on equity instead of long-term debt. So just recently it has got safe. So let's go to return on equity. I'm looking for 8% or more than that for it to be brilliant. Let's have a look. So I can see that it's a minus return, which is not what I'm looking for. And I'm looking for a positive return and ideally 8% or more than that. And before that also it's a minus. So since we have data, it's a minus return, which is not ideal.